Hey everyone, welcome back to the channel. If you didn't see, we just finished up part one. It's just kind of a company overview of Microsoft and some things to think about as we build out this model. Usually break these out into two videos now because some people like, getting a little bit more background. Some people just want to see the DCF built. So we'll hop into the DCF here. A couple things to note. So I went ahead and pulled 18, 19, and 20. If you're not familiar with how to pull this, I'll show you real quick. All this data is publicly available. You go to sec.gov. From here, you'll go ahead and click more search options, and you'll go ahead and type in their ticker, which is Microsoft, MSFT. And then their annual filings are going to be 10K. You can filter down here, 10K, or the other alternative, if you don't want to filter, you can just kind of scroll down until you see the 10K. You'll click on that. The first link will bring you to the full filing. There'll be a little table of contents at the front, and you can, a couple places to look for that are kind of the first places I look in a 10K management discussion. This is going to talk about the overall company performance and what's really driving it. And you'll see here they give you a lot more detail than we will in the financial statements. But like Office Consumer Cloud Service, 11% growth. Commercial cloud revenue increased 36% to 51.7 billion. Xbox, and then they'll also break out usually revenue into kind of sub-segments of the main financial statements. So in this one, they give us productivity and business processes, intelligent cloud, and more personal computing. And then they'll break down what really makes up those three segments. I think they break that down right here. So productivity, business, and intelligent cloud. It's like the Office 365 mostly. LinkedIn is in there. And then some enterprise service. Intelligent cloud, they actually break out into a second line. So I'm guessing that's mostly Azure revenue kind of stuff. And then more personal computing, right? So Windows OEM, that's just kind of the base operating system, I believe. But that's like what they're selling to computer manufacturers. And then Surface revenue, Xbox is in there, and then search, which unfortunately Bing is dying. So that's MD&A is always important to look at, just to kind of understand a little bit. And then the financial statements themselves, you'll see here for revenue, they break it out between product and then service. So it's a little bit less detail on this. But so I went ahead and copied over those. And I actually, for the income statement, I pulled over two parts. I did pull over the revenue that they have in the MD&A, and then the other income statement that is down in the financial attachments. And you'll see the revenues tie out just to how they kind of look at it. And I think for Microsoft, it's better to think about it in these three divisions than it is between product versus service. Just because here, we can kind of think of this as Xbox and OEM. This is cloud for the most part. And then this we can think of as productivity and LinkedIn, really. That's kind of how I think through it. So we have that. And then I didn't bring over the whole cash flow statement. We only really need a couple items off of it. So I pulled in DNA, stock-based comp. I always copied this over just to kind of get an idea of it. In Microsoft's case, it's not that big. With some IPOs, you might adjust out to try to calculate free cash flow. Stock-based comp really is just like employee compensation, but paid through stock, it dilutes you. So, I usually try to leave it in, but sometimes I'll pull it out. And then PP&E is just CapEx, purchase property, plant, and equipment. So we can have the CapEx numbers, balance sheet, copied over the full balance sheets, and we'll just really need this for our working capital calculations and then for net debt. So we'll go ahead and we'll bring over to the DCF now. And what you'll see here, 18 through 20, the green cells, this means it's linked back to the income statement or the balance sheet. And then black is just like an on-page formula. So we can see that, and then these are all calculations of kind of the sales growth by subdivision, and then COGS as a percent of sales, SG&A, things like that. So all the assumptions we have to make. So once we fill out these assumptions, we'll get a valuation, and that's kind of the DCF will be complete per se at that point. So first thing to think is just productivity applications, right? So it's been growing, I would say mid to low single digits. And you could go research this market and see kind of build out your actual assumptions, what you think is going to happen. My thought really around this is they're going to continue to transition more people to Office 365 as they phase out their legacy products and as people kind of upgrade in the cycle. So I think like 2016, I know you could buy the full-blown version, which is what I actually use. And I purchased a long time ago, and bought a version with like 5, licensing keys. So I'm only on like my second computer since then, so I'm still using that. But, I think more people will continue to switch to the productivity applications. So I don't think that this growth is going to necessarily slow. And if anything, it might grow if they can start pricing better. But obviously, I don't think they're going to be able to continue the growth forever. With that said, I mean, it already is a $46 billion base business. And LinkedIn's in here, so I think, right, LinkedIn is could be a potential large growth driver as well. So I'm going to kind of leave them flat at their growth rate and then just have them, um, ooh, some fun formatting for us there, and then have them slowly just kind of drop down into like a high single digits growth over the course of, and there we go. So we'll do that and kind of just, I think that that's fair. I mean, obviously that becomes a massive 120 billion. That might be a little aggressive, but I think, with LinkedIn and productivity suites, if they can continue, I think the big growth driver here, because it's only 6 billion of this revenue right now is LinkedIn, of this 46. So if you could really have LinkedIn become a 20 or 30 billion dollar revenue, product for your company, which I don't think is that crazy. I think, I'm sure if you look at Facebook, they drive way more than, and that, we can pull that up real quick just to kind of get an idea. Let's go to sec.gov. And then I think Facebook's ticker is just FB. Let's look at their most recent 10K. And I'm sure if we look at their revenue, and obviously LinkedIn and Facebook aren't the exact same thing. I don't disagree with that. But I think, just to get an idea of how big could it actually be, right? Facebook went from 55 billion to 86 billion in revenue. And that's going to be Instagram and Facebook. So thinking that LinkedIn could become a 20 to 30 billion dollar company, I don't think is unrealistic. So I think it's probably fair to think, this could continue its growth. And then if you're saying by 2030, if half of that is LinkedIn, or even a third of that's LinkedIn, then you're really saying in 10 years time, the remainder of the productivity suites have only doubled. So average like a 7% CAGR. So I think that's reasonable. Intelligent cloud, I think that more and more businesses are shifting to a cloud model. I know Azure offers like a hybrid model, which is a little bit different than some others. But let's just to kind of guide, so our estimates, we'll pull up Amazon. We'll see what their cloud business is currently pulling in. And honestly, I haven't looked at this, but I know cloud is really the main driver for, and that's like the most consolidated financial statement I've ever seen. Financial statements, do they have more detail here? Net product, net service. So they don't tell us how much of that service is AWS. Let's see, maybe in MD&A they do. AWS, here we go. So AWS is 45 billion, growing from 35 billion. So this intelligent cloud is including some stuff other than just Azure. Let's see, I guess let's just look at the growth rate for AWS. AWS is growing in the 30% range. We're number 2 at Microsoft, growing at 20. So, I think maybe this is crazy, but we're going to say they're going to keep growing, and then once most companies are kind of on the cloud, growth will start to go down, and it'll become more of a pricing war. I think that's hard. I think to really give a fair value to Microsoft, you really have to understand the cloud business, and I can't say confidently that I do, but um, we'll leave that assumption there for now, because I mean that becomes, I mean, it's growing astronomically. So that's aggressive, but we'll see. And obviously this is just a first pass, so we'll tweak a lot of this. More personal computing. So this is really OEM Microsoft stuff, and then Xbox is in there and Surface, things like that. So I think 2021 you're actually going to see a boost here just because of the new, man, all the formats here are wonky. You'll see a boost because they just released the new Xbox, but I think that will be short-lived into 1 year, and then we're just going to make this kind of like a mature business that's going to grow at inflation. Um, we'll see. And I mean, look, so they've grown 14% in total. We're going to say, okay, you're going to grow 15%, 15, and then normalize back out, and then slowly regress down to 12. Now, can they keep so low single-digit growth for the next decade? I don't know. If they do, I'm going to guess they're undervalued currently, but we'll see. And then COGS, we've seen their COGS actually improve, so I think there's definitely economies of scale with some of the cloud stuff, right? I think they already have a lot of the data centers, and it's just moving people on. Um, so I don't think necessarily that, when you're running the data center, I think it probably costs the same regardless of how many of the servers are. I mean, obviously servers have costs to run, but I think there's definitely economies of scale there. But we're gonna to be conservative, we're just gonna say their margins aren't gonna improve or get worse. SG&A has been getting better. Obviously, as the company gets bigger and more profitable, SG&A doesn't necessarily grow proportionally, but we'll leave it at the 17%. And then other expenses, the R&D. In this case, so we're going to leave that at 13% tax rate. Here's kind of like what they paid historically. There's a lot of weird stuff. Just in 2018, I think there was the like repatriation of cash. So I think that caused like large tax impacts for a lot of companies. And then there's some weird tax credits, but we'll leave it at 21% because that's kind of the corporate tax rate. CapEx, right? So it looks like it's been averaging 11%. So we'll leave that there. These should actually all be blue as well, just so when I upload the model, if you pull it down, you'll know where you can make assumptions in your own model to get your own valuation here. And then depreciation as a percent of CapEx, it's 88, 84, 83. I think that's a good sign. I usually just leave it at 80%. The thought process here is if you're expecting growth for the company, then honestly the company should have, so if you're expecting growth, then the company should be investing in itself, which would be capital expenditures. And if you're spending more and more on CapEx every year, some of that is growth CapEx and some is maintenance. Usually about 80% is kind of a good estimate of the like 20% growth. So every year it should be going up a little bit, but your depreciation should stay lower than your total CapEx. If CapEx is less than depreciation, that means leadership has stopped investing in the business and it's eventually going to slowly kind of die, to be honest. But net working capital turnover, so this is the last thing to calculate. Some of my other videos, I do it as like current assets as a percent of sales or current liabilities as a percent of sales. I don't think it really matters how you do it, but net working capital turnover, what this is your wrong tab there. This is your revenue divided by your working capital. So how many times a year does your revenue cover your working capital? So that way it kind of scales. It's very similar to just doing this as a percent as well. But this has been averaging around 9. So we'll do this at 9 times. From there, that'll link up and give us the net working capital that we need. And so the first pass here, I think we're going to get some crazy valuation. Yeah. So I think that this is very much probably the bull case. So weighted average cost of capital, and actually I guess as an investor in a blue chip company, you can expect probably 7 to 10% returns a year. Adjust that for inflation, you're getting 5 to 8, something like that. But we'll say 8%. I don't think Microsoft is necessarily super risky. And maybe the current market valuation is kind of a bull case on it, and you have to really believe in their cloud growth, because that's what it's kind of looking like now. Terminal growth rate, this is usually going to be something between 2 to 4%. I usually try to just set it kind of close to inflation. 3% is usually pretty fair. The idea here is just like if it's going to grow in perpetuity more than inflation, this company would become like it would take over the world economy. It would be the only thing that matters. If it's growing less than inflation, then it's just going to slowly kind of die, which is probably true for most companies. But if you just set it equal to inflation, then that means every year they're going to just kind of putz along and grow at the same rate of inflation, and value isn't going to be created or destroyed really. Um, Terminal value. So if you're not familiar with this, you take the last year's unlevered free cash flow. Um, you're going to multiply it by 1 times the terminal growth rate, and then you're going to divide that by your cost of capital minus your terminal growth rate, and then you're going to NPV that back to today's terms. From there, you're going to add NPV of the free cash flows and then the present value of your terminal values. So that gets you 1.3 trillion less net debt. So we haven't linked this up yet. So net debt is equal to, so we're going to do total debt, and then we're going to subtract out cash. So if it's a negative number, that means you have more cash than debt. So what that means is if you were to buy the company, that should actually be subtracting it. So enterprise value is the total price you'd pay to buy the company. So in reality, the equity would be worth 1.4 billion, but because they have 73 million of cash, or 73 billion of cash on the balance sheet, then when you bought the company, you could instantly take that and pay off your debt or whatever. So the actual full value of the company is 1.3 trillion. So this gets us about a 1.4 trillion dollar valuation. And here's a sensitivity table that we can look at. And this is saying if we change the perpetuity growth rate from 3 to 3.5%, and then our weighted average cost of capital, which should really, let's put 8 in the middle, 7.5 here, and then 8.5 here, you'll see you get a kind of a range of valuations from 1.3 trillion up to 1.7 trillion. So, this is actually probably a pretty fair model that most kind of investor, I would say, right, when you do a model and you get something like this, I would say this is kind of a bull case. We're really betting cloud continues to grow even after it's this super kind of large business. I don't know if that's necessarily true. But right, I think their market cap, we can check what it closed at, but I think it's around 1.7 trillion, 1.8 trillion. So, I think you could say investors maybe are only requiring 7% return. If that's the case, and you believe kind of some of these assumptions that COGS and SG&A and other are going to stay relatively the same, but you really think that they can keep up the cloud growth, and then just have their kind of more personal computer just kind of putz along and slowly kind of decrease, and then their productivity, they can keep that market share and keep growing and getting people on Office 365 as a SaaS kind of product. And that's actually probably fair because corporations are all over the productivity suites. So every year, if you increase the price a little bit, a Fortune 500 company isn't going to switch to Google Sheets. All their, everything they do as an organization that has any analysis is done in Excel, and porting that all to Google would be probably just about impossible. So they really can kind of price things as they want. So, 1.8 trillion, but I think the big assumption here is intelligent cloud, right? So if we were to say, cloud, great, it's a $50 billion business, but we think it's going to slowly decrease until it's just like low single teens. Surprisingly, that doesn't impact them too terribly still at that kind of decrease. 1.6 trillion. But if we say most companies that are going to be on cloud have transitioned to cloud, and every couple of years a big client is going to switch between AWS, Google, and Azure, but it's going to be kind of all net neutral, and we don't think there's still a whole ton of growth left to be had. Right? You can see as like you really start to adjust this assumption here. Um, as you really start to adjust this assumption here, your your valuation is going to keep going down. And the other thing is, right, if you don't think 7% is enough for you to want to invest in this, if you require 10% investment, right, the current, you're going to have very aggressive assumptions to be able to realize the 10% growth. Um, but 7%, is a blue chip company that, they pay a dividend of whatever. If you're just happy collecting the dividend and sitting there and having them kind of be the safe, stable investment, I think they're probably, in line. Their valuation might be a little heavy on the intelligent cloud aspect, but I guess only time will tell. They've released 2 quarters of data so far for 2021 because their fiscal year I think actually ends June 30th, or July. Is it June or July? I think it ends June. Yeah, their fiscal year ends in June. So they've actually released 2 earnings release already, and cloud has actually been a huge driver still. So, you know, the cloud assumptions probably aren't that far off to think that they can kind of, you know, maybe maintain slash slightly decrease this stuff and just kind of keep growing. I think cloud really is the service that's here to stay. So, I think this is one of the few companies that I've looked at so far and thought, this valuation is actually probably pretty reasonable if you really can get behind the cloud assumptions. I think that's kind of the big piece, and something I would definitely recommend if this is something you're actually looking to invest in. Do more research on cloud to make sure you fully understand that business and the growth drivers there. Because I'm not sure I entirely understand it, but definitely seems like a reasonable um, valuation at 1.8 trillion, which seems crazy to say because I think we just had trillion-dollar companies in the last few years. But yeah, I'd love to hear your thoughts and opinions. If you think differently, please leave comments below, and maybe we can get a little discussion going. So thanks for tuning in. Hope you enjoyed the video, and stay tuned for more valuation videos in the future.